So a few big questions are weighing on investors tonight. Will this bull run continue? And is tech the play for 2024? So let's talk about all of it with our lead-off market panel, CIC Wealth Management Executive Vice President and Financial Advisor and CNBC contributor, Malcolm Ethridge, and Laffer Tengler Investments CEO and CIO, Nancy Tengler. Nancy, let's start with you. Are you concerned here that the broadening of this rally that many expected has just not happened yet?
No, I'm not, Eamon. I mean, I think there's still plenty of time, but I think we also need to put this in perspective. If you look over the last 2 years, the NASDAQ is actually down through the end of last year, down 2.4%. We're now in an environment where we're seeing earnings improvement. Margins for the tech names are expected to expand, earnings and revenues as well, much faster than the rest of the market. So if you're in a mode where you're in a slowing economic environment, these are the names you want to own with fortress balance sheets. I think I read an IBD study that said 13 non-financial companies in the S&P have over $1 trillion in cash and investments. So that's where I want to hide if I'm worried about a slowing economic environment. But we're also overweight industrials. We like financials and not just the banks, but an expanded view. So I think that the market, the rally will continue to broaden, but you've got to own these names because the secular narrative behind them is very strong and will continue for a decade.
Malcolm, over to you. If you purchase small and mid caps in the hopes of a broader rally, what do you do now? I mean, those guys are down. It's the big guys that have been leading this rally. Do you put more money into that group, or do you stick with what's working?
Yeah, I think kind of to Nancy's point, that broadening is definitely going to be tested every single time the market starts to show some volatility here, right? Because the fortress balance sheets that you mentioned that tech companies have is really what we see as safety and stability in times when markets get rocky, where we used to look to bonds to be that ballast and hold us up when the market started to get choppy. Now we see mega cap tech once again coming in to save the day. And I think that trend is probably going to continue throughout the better part of this year, as it's sort of the knee-jerk reaction trade anytime things get rocky.
So, Malcolm, we're sitting here on a Friday night. Look ahead with me to next week, because we've got key earnings coming up next week with Microsoft and Tesla. What are you expecting from this earnings season from tech? Are they going to put up numbers that justify the rally that we're seeing?
Well, layoffs have persisted through 2023, similar to how they started and ran all the way through 2022. I think in 2023, we had something like 260,000 layoffs among close to 1,200 tech companies, I think, according to layoffs.fyi, their latest numbers. And so that is what's helping to improve those margins that Nancy mentioned and helping to make sure that tech companies are still going to show profits once they report in the coming quarters. And so I do think that we'll still hear positive earnings from the mega cap tech names, which will once again help bolster the money that flows into those names and take it away from what would have gone into, say, like an IWM looking for that small cap trade.
Yeah, so let's roll back the tape here, because FundStrat's Tom Lee was on Last Call earlier this week. He was last year's most accurate strategist. He made this prediction on where stocks could be heading next.
I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
So, Nancy, the question to you, we made that new record today. You heard Tom predicting, but do you think he's right? Should investors expect a major pullback after we saw the record?
Yeah, for a whole host of reasons. But one is also that it's an election year. And if you go back and look historically, you've always seen declines in the first quarter before the market takes off. So I think you want to use that weakness. And for many of the reasons Malcolm mentioned, you want to use that weakness to add to the winners and also the highest quality names across sectors. So I think we will be in for choppiness. We get a correction about once every 12 months. That's good for stocks. But don't let it scare you out of the market. Use it as an opportunity to add to holdings.
So, Malcolm, the obvious question to you, we're at record highs. What do you buy, right? I mean, everything's expensive.
Yeah, that's fair. I think that to Nancy's point about the potential pullback coming, maybe you're not buying anything just yet. Maybe you're waiting a couple of weeks to see exactly what's going to happen, because, yes, we did just notch an all-time high, but underneath the surface, about 25% of the companies in the S&P have already retrenched. And from their all-time highs they hit in mid-December and are below their 50-day moving average. And for context, mid-December, we were at less than 10% of companies were in similar territory. And we haven't seen that kind of behavior since about July of 2023, where the markets started to just go sideways for several weeks from there. And so I think maybe you're going to get a better buying opportunity than today at an all-time high. And maybe it's a good idea to just sit in that dry powder for a little bit and see what happens.